How do some people go from owning one property to an entire portfolio? It's not luck, and it's usually not by buying 10 houses all at once either. I'm Judy. I've spent 20 years helping people take their first step into UK property and then grow from one investment into an established portfolio. And at Select Property, we've spent over 22 years delivering exceptional developments across the UK. So in this video, I'm going to run through the full guide to building a property portfolio from scratch, including the first decision you must make before you buy anything, and the step that turns one property into two, and then two into a portfolio. So before we dive into the exact steps, I want to talk about a key factor that people sometimes misunderstand about mortgages and home ownership. Many people think they should completely own one property before they buy another, and therefore believe they should pay off the entire mortgage first, which could take 20 to 30 years in some cases. When actually, you can use equity and profits from your first property to fund your next, even before it's paid off. You don't have to wait decades, and your property increases in value, you pay down some of the mortgage, and you build equity. That equity can then be released and used as a deposit for your next investment, and so on. This is how investors scale from one property to 5, 10, or even 20 properties over just a few years instead of waiting a lifetime. Now let me show you how you can do this step by step. Step 1. Define your investment goals and pick a strategy. The first step to success is to know exactly what you're building towards. So you need to look at defining your goals. Sometimes people dive into property investment without a clear strategy. For example, they may buy the first opportunity that comes up. They may even use their first personal property and turn it into a buy-to-let. It's important to think about whether your plan aligns with your actual financial goals or timeline. So before you buy any property, you need to decide what you're actually trying to achieve. Are you looking for quick capital growth through buy and flip properties so you can reinvest the profits? Or are you building a portfolio for long-term passive income through rental returns? These are two very different strategies that require different types of properties entirely. So let's run through them. First up, the buy and flip strategy. This strategy often involves buying a lower value property that has the potential to be worth substantially more with work. This is normally a project property that may need renovating to increase the value. Investors will buy the first property, upgrade it, and sell it on for a higher price, normally with a quick turnaround. Historically, this has been a very common strategy for investors in the UK, but with increased material and labour costs and additional costs like stamp duty, a tax you have to pay each time you buy and sell a property, it's becoming more difficult to make this viable, and therefore it can present profit risk and sometimes even end up costing you money. Therefore, investors are exploring other strategies. Let's look at the long-term growth strategy. If your goal is regular income and increases in your capital growth, you'll be looking for quality properties that residents are going to want to rent and future purchasers are going to want to buy. Have a look for towns or cities with a growing population, thriving job markets, and large educational institutes, as these are all factors that contribute to growing tenant demand. By investing in quality property in one of these areas, you'll secure additional monthly income through rental payments and avoid void periods which impact your income. If you decide to hold the property for a few years, you'll also likely gain capital growth, as in the UK, property prices historically increase year on year, especially in high-performing locations. So really think about your specific investment goals. Is it monthly rental income, long-term capital appreciation, or a mix of both? Once you know this, every decision you make about which property to buy becomes much clearer. And if you're at the stage where you know your goals but you're not sure which property matches them, that's exactly what our consultants specialise in. We offer free investment consultations where we'll walk you through your options based on your specific situation and goals. You can book your free consultation using the link in the description. So now that we've got your goals clearer, let's move on to the next step. Step 2. Start strategically. When starting out in property investment, some people often either buy the lowest value property they can find, or they max out their affordability trying to buy multiple properties all at once. Your first property is arguably the most important one because it sets the foundation for everything else. This needs to be a property that aligns with the goals you just defined. whether that's to buy and flip for properties' quick profits or to opt for a longer-term strategy with passive income and capital growth. Your first property should be one you can comfortably afford, but more importantly, one that will actually perform and give you the returns or equity you need to scale. Once your first property is performing, you've unlocked the key to building real wealth. But this next step is one often overlooked. Step 3. Use profits and equity to expand. So once you've secured your first property, what next? You could sit back and watch it grow in value, but to build a property portfolio is to take action and to use your equity. And by equity, I mean the percentage of the property that is actually owned by you and not the mortgage lender. As your property increases in value and you pay down the mortgage, you build equity. Most investors using this strategy will actually not pay down their mortgages though and choose to use interest-only options to ensure better cash flow. The equity you're building isn't just a number on paper. It's money you can access and use to fund your next investment. You can release equity through refinancing, or if property is generating rental income above your mortgage payments, you can use these profits to build up a deposit for another property too. This is how investors, and you too, can scale from one property to 5 or 10. Another consideration is off-plan properties. Off-plan properties are particularly strong for portfolio expansion because they often complete 2 to 3 years after you buy them. That gives you ample time to arrange your finances, release equity from your existing property, and align everything before completion. Plus, you could benefit from capital growth during the build period, meaning you could gain, say, 10 to 12% equity on the full property value, whilst only investing your own capital on the down payment over the period of the build. Finally, step 4. Planning your exit strategy. Investors, of course, focus on acquiring properties, building wealth, and putting their strategies into practice. But it's also important to think about an exit strategy for life changes, market shifts, or when they might want to liquidate assets. An exit strategy isn't about planning to fail, it's about being smart. Life changes, markets change. You might decide you want to retire early, move abroad, or shift your investments into something else. Or you might decide to sell a lower performing property to reinvest your capital into a higher yielding one. My recommendation to investors is to know your options. At the moment, for example, in the current market, mid to long-term buy-to-let strategies are outperforming quick flips significantly because renovation costs have increased massively. Holding properties for 10 to 15 years and benefiting from UK properties' long-term appreciation and capital growth can be a stronger choice in today's market. But think about your timeline now and what matters to you. What factors would trigger an exit for you personally? Maybe your age, profit target, or market conditions. And if you do exit a property, have a plan for where that capital goes next. Don't just sell and leave money sitting idle. Now, it's one thing to understand these steps. It's another thing entirely to execute them in today's market with confidence. That's why we've put together a complete resource for you, an investor toolkit. It includes investment guides, tools for investors such as an ROI calculator, and contact links to our expert consultants who've been doing this for 20 years. You can access it all using the link in the description. So now you know exactly how to build a property portfolio from scratch and defining your goals, identifying the best strategy for you to scale with equity and planning your exit. But here's the question every investor asks at some point. Is property actually the best place to put your money? Or would you be better off in stocks? That's exactly what we will break down in this next video. What will make you richer, property or stocks? Watch it next to see real numbers behind both strategies.